The following program paid for by Rosenberg Financial Group. Providing live finance advice since 1993. It's time for Your Money with Steve Rosenberg, Sherry Goss, Randy Goss, and Becca Wilton. To participate in today's program, call 478-742-0940 with your financial questions and comments. And now, live from the Macon studios of News Talk 940 WMAC, it's Your Money.
Good morning, Middle Georgia. Randy and Sherry Goss are here.
Good morning.
I got a little buzz in my head. Oh, there it goes away.
I thought that was normal.
Nope. Anyways, Randy and Sherry Goss are here from Rosenberg Financial Group to take your calls, 478-742-0940. It's been a very interesting week, news-wise, client-wise, people that have called me wise. It's just been wild. So we have a bunch of stuff to talk about, but give us a call if you have any questions or insights that you want to share. So I promoted this last week, and I'm going to continue to do this until I do this event. On September 8th from 3 to 5 p.m., I'm going to be speaking at Watercrest Senior Living, and it's a very high-end senior living facility that's being built. Actually, construction is probably done. Furniture is probably showing up this week on Bass Road, right off 75, right across from basically Publix and the shops.
Yes.
It is fabulous. It is beautiful, and I had a tour and just was blown away by the staff and the place. And so I offered to do a program and to present something for them and to promote it because I want people to understand that this place even exists. And it may not be right for you, but you might know somebody that will want to live there. And the chef was the most fun part of the experience because of the kind of food he's going to create for different people, for different whatever is going on in your world.
Right.
And he was talking about people who have dementia, and he's been all down the rabbit hole of all of these things of seniors and food and nutrition and different diseases and what works for some and what works for others. And he says that some people, when they have dementia, have a problem with texture of food, or they might have a problem even swallowing. And so he has a whole plan for all of those people that's specific to their needs. And I've never seen anybody like this in my life.
That's going to be one dynamic kitchen.
Yeah. Oh, it's huge. It's a chef kitchen with a real, honest-to-God pizza oven, the whole nine. And they have a giant... It's like a stainless steel glass front refrigerator, but it's actually a hydroponic herb growing thing.
Wow.
It is
I like that.
So cool. So they're going to have fresh herbs on everything. And he's all about fresh and tasty and texture and health. And the guy is just fun. It was worth me going just to meet him. So anyways, on September 8th from 3 to 5 p.m. Is the event space that you can make a reservation. It's in Macon, right off Bass Road, kind of to the left of Natalia's. I'm going to talk about a longevity risk and lifestyle planning for retirement. I'm only going to talk 20 minutes. Then they're going to do their presentation, and then they're going to have food and drinks, and you can get tours of the place and see it and just check it out for fun.
Is it just going to be one event, or is it going to be multiple events?
I only have one at this point. We'll see how this goes.
Do you know what the response rate has been so far?
I had a phone call after the show last Saturday of a client that she's going, and I'm telling everybody to contact them direct, so I don't know.
Okay.
But anyways, you're going to call Mandy Walker at 478-250-9154. And if you don't have your pen handy and you missed this, just email me, Sherry, Sherri, at rfmoney.com. Same thing goes for if you hear us read an article and you'd like a copy of it, we can scan it and email it back to you. Just shoot me an email. Easy peasy. Anyways, let's talk about the market and what's going on in the world. We subscribe to a lot of newsletters. So here's this guy's take. So he starts talking about housing prices and how they're at a dangerously high level. I said this month's survey by the University of Michigan found that almost 70% of consumers felt that housing prices were too high, which is over twice the level at the peak of the 2005 housing bubble. And he's calling it one of the top warning flags to watch for this year. He also, let me see here, talks about another bunch of warning flags. High interest rate risk is another one. Valuation risk of the stock market, which is high. And I should have highlighted this better.
10-year treasury.
10-year treasury rates, yes. So consumers grew far more pessimistic in this month's preliminary report due to a broad combination of fears, as he just summarized. An important warning flag is also developed within the housing market. Slowdown in traffic of prospective buyers, which is only normal because prices are really high. And then he talks about the margin debt. So
Yes.
is margin debt, which measures the amount of money that investors and traders have borrowed to purchase stock on margin. It is considered by many to be a gauge of speculator sentiment and leverage, and will often rise dramatically in the latter stage of a bull market, and it is at a peak right now.
And when you start seeing it dropping, that's a big signal.
Yes. Compelling evidence that the housing market is in a bubble, which we already know that. To be clear, this is not an exact replica of the 2005 housing bubble. Today's environment has far more to do with interest rate and affordability risk, while the prior bubble centered around credit default risk. Totally different animal. That was a nightmare back then. Just a year ago, the median family home price was $297,000, as the Fed pushed 30-year mortgage rates down to 2.9%, which is the lowest level in history. Today, the median home price has jumped to $370,000.
Wow.
Even though mortgage rates are unchanged from a year ago, the resulting monthly mortgage payment has increased 24%. So people are going into more debt to buy a house because rates are low, but prices are high. And there's risk in that because can they afford it? And now what if we go through another COVID shutdown?
That's right.
And they lose their job, and then we're going to have to spend piles of money on unemployment to keep these people from losing their homes.
And the way the administration's going now, we'll just bail everybody out.
Right. Some Fed governors are becoming increasingly more outspoken about the central bank's role in supporting the U.S. housing market. Support has not only been given through low interest rates, but also via the direct purchasing of mortgage-backed securities. The Fed's balance sheet, which recently reached $8 trillion for the first time, is comprised of almost 30% mortgage-backed securities. This is the first place I've even seen this data.
Yeah.
I haven't seen it in the news anywhere. No one is talking about this, and that's a big problem. So not only has the Fed fueled a housing borrowing spree through historically low interest rates, they have also provided additional liquidity to mortgage originators as they purchase these bonds in the open market. Their meeting minutes released this week discuss a plan to start trimming bond buying programs later this year. Given the scale of their involvement, reducing monthly purchases of treasuries and mortgage-backed securities, which are currently set at $80 billion and $40 billion respectively, could put some upward pressure on interest rates and in turn increase volatility in the equity market. So interest rates are important to everything. They affect everything. While the ongoing bull market continues to merit the benefit of doubt, managing risk in today's market environment requires a disciplined and incremental approach. Last point that he makes, Thursday morning, both the S&P 500 and NASDAQ index are rallying in positive territory, but with over twice as many declining stocks as advancing stocks, which is very interesting. More notably, over the past couple of months, we've seen multiple instances in which the S&P 500 index closed at record highs, while fewer than 50% of component stocks were above their 50-day moving average. So we're invested in our, as disclosure, in our portfolios that we manage, predominantly in technology, healthcare, consumer discretionary, materials, and industrials for infrastructure spending.
And that's right now.
That is right now.
We move in and out of different sectors based on the risk.
But that's where we are because that's where the growth is.
That's right.
And so, if you're in just an index, you might be up. It'll be interesting if you went in and really looked at the S&P 500 index. And if you go to Yahoo Finance, on the very top of the page, it has the S&P 500, the Dow, Russell 2000, gold, silver. You can scroll through and you can see, and it's interesting. If you've never looked at it, especially if you're in the C fund, let's say you're in TSPC
right.
fund, that is the S&P 500. It'd be good for you to understand what that is in, and it will show you. If you click on it, you can scroll down and you can see the stocks that are up and the stocks that are down, and look at the sectors. You can do the same thing. So the G fund is federal bonds, treasuries. The S fund is the S&P 500. Wait a minute. The C fund is the S&P 500. The S fund is the Russell 2000. The I fund is international.
Yeah.
And so you can go into TSP2 and you can look at what the components of those funds are. But it's important for you to understand what you are in.
It is. And you know, Sherry, the Dow closed Friday at 35,120, and the S&P closed at 44,41. Now, the Dow, year over year, as of yesterday, is up over 27%.
And the Dow is only 30 stocks.
That's right. And so when you get a positive or negative blip on any one of those 30 stocks, it can have a big impact on what you see on the news. It could be just the one, like the biggest stock. Yeah, and see, and then the S&P is up year over year as of yesterday over 31%. And see, this is what CNN and all the news feeds, they primarily hit these two indexes, and there's plenty of other ones for people to look at. But, you know, if you're saying, well, why is it my portfolio up that percentage? It's because of the risk in your portfolio. It's depending on the mix of goods they have in there. So you can't look at that. But the problem that I see is that so many people get caught up in this and they go, well, I need to go throw some money at the stock market. Unless you really know what you're doing, you know, you might get lucky and you might not. So you got to be careful with that.
And it depends on your age.
That's right.
And your income.
Risk tolerance.
How dependent you are on this money in retirement.
That's right.
That's why our clients are fairly risk averse, and we're never 100% in the market.
That's
ever.
right.
So anyways.
But, you know, while it's impressive, you just have to be careful. But Friday, the dip buying was on full display as the stock market rebounded from the sell-offs on worries about the Fed's tapering of its bond purchases, as you talked about just a second ago. And the Dow average gained 225 points, and you know, most of the other indexes were up as well. Still, the major averages suffered losses week after the Fed's July meeting. Minutes showed that the central bank started considering dialing back its $120 billion a month bond buying program. In many ways, the market has become addicted to the Fed's liquidity spigot, and so many mentioned that tightening policies can cause more indigestion. Next week, the Feds will meet virtually for their annual economic policy symposium, which normally is held in Jackson Hole, Wyoming, and investors will be closely monitoring what comes out of that meeting because it will dictate which way the Fed's going to go and how it is going to impact you.
What day was that again?
I didn't give the actual date, but it is next week.
Okay.
You know, last week, Reserve Chair Jay Powell said at a press conference, the extent of the downturn and the pace of the recovery remain extraordinarily uncertain and depend in large part on the success in containing the virus. We all want to get back to normal, but a full recovery is unlikely until people are confident that it's safe to re-engage in a broad range of activities. So that's a true statement, and you can see it across the spectrum as the variant D is taking hold, and you know it is what it is. So, in the year plus that it's followed, the economy has enjoyed a very strong recovery, as we talked about with the different stock the index figures. But the current spread of the COVID variant D throughout the U.S. now has economists cautioning that the pandemic is again throttling the speed at which the economy is bouncing back.
And guess what?
What?
I read this morning there's a variant L now.
Lovely.
That's not what it stands for, but that probably is.
Let's just call it lovely. We need something positive in our lives, you know. But anyway, following Tuesday morning's retail sales report, the team at Bank of America said that third quarter gross domestic product is tracking for a growth of just 4.5%, which is well below the 7% that they were hoping for. And going on here, the chief economist Ian Shepherdson with Patheon Macroeconomics said the downturn in their forecast, they downgraded theirs from 7% from 7% from 10. The downshift in the forecast is primarily a response to the impact of the COVID variant, and they're looking at things like restaurants and airline passenger numbers and overall mobility rates in the southern states, no less. Anyway.
You would know that if you were in downtown Macon.
Right.
Driving around with the top down with your stereo blaring at 100 decibels.
But you know, that's exactly right. You know, Walmart came out last week as well as Target, and Walmart said that they've seen an increase over the last quarter.
In-store sales.
Right, and the CEO of Target has said that they still see people, their traffic numbers are way up. And it may, I don't know if it's people just wanted to get out or not, but they are out in the store spending money. But, you know.
With the mask on.
Right. But it's a reminder that these two things can coexist. The economy can be losing some momentum as fiscal stimulus fades and the pandemic continues to spread. As investors can remain confident that the future growth and profit opportunities for America's biggest companies can remain robust. So, That's a positive sign.
But it's a divergence. It's two different stories
That's right.
in the same article, and it just is what it is.
It is. It is what it is. So
and you still have supply chain issues where you go to Kroger and the shelf is empty, go to Walmart and the shelf is empty. It's so interesting to me. And I was talking to a client that's in the trucking industry, and he was talking about the delivery of stuff. And his company that he works for is spinning off all the small, short-range deliveries. They're getting rid of it because of the cost and the time it takes. And I don't know if they're dumping it off on the post office or what they're going to do, because the post office already loses money delivering all that stuff for Amazon.
Well, we do have an article in the back of our little package here that talks about the last mile.
Oh, that's right. Okay, well, we won't get into that now then. So let's get into this one. You had a really good email from a friend asking for advice about pension versus lump sum payout.
Let me get to that. Let me find that real quick.
You got lost?
No, it's not lost. It's just maybe a little misplaced. Okay. Anyway, this buddy of mine, really high school friend, and he's constantly picking up tidbits from other people that are in the same position that he is in life. You know, and a lot of times they're having these discussions over a beer or a bratwurst somewhere, you know. And it's amazing. We've talked about this several times about people taking advice from people who don't know. And they're sitting around having a beer, and he starts talking about the Jewish.
Talk about that. Is that in here?
SHMITS.
Shemitah. I guess.
Anyway, it's basically the translation is sabbatical year, and it is basically it's a time cycle and one of the cornerstones of Jewish life, and it's known as the year of release. So about every 7 years, they said you have to let the land be untilled, and then they also say that there's a time to
and this is biblical.
Yes, that all debts are to be forgiven, the land's life fallow. Private land holdings are to become open to the commons, and staples such as food, shortage, and perennial harvest to be freely redistributed to all accessible. So,
like a reset.
Yeah, it's like a reset every 7 years, but they're only pulling out what is applicable to their sermon at the time, it seems like, because I don't see them saying, I'm going to forgive everybody's debts and that they're owed to me, and they're not letting their houses go back to the general public.
Who is not saying that?
The person that was talking to Chip.
Oh,
he just pulled out one thing that was...
Yes, scare him.
To scare him.
Because what did he say? It was scary.
Well, Chip, I keep using the guy's name, but not his last name, okay? They said he needed to take his retirement. They were offering a lump sum retirement versus the annuitized retirement from the company, and the person was saying you need to take it all and go invest it yourself because the end times are coming, and the Shemitah is all happening, and it just
you better take your money out of there.
Scared him to death. So he emailed me and goes, "What am I to do?" And so I provided him. I got 2.5 pages worth of answer, probably more than he wanted. And
I wondered if he read it all.
Yeah, I think he probably did. But the underlying question that he had is, should I take my lump sum distribution, or should I go ahead and just let it go into an annuitized pot of money from the firm, the company, and let them pay me a monthly distribution? So we had a lot of great conversation over this, Sherry and I did, but the point that we came to is this is becoming more and more common. And Sherry, I've seen a couple of them. You've seen several. And so we wanted to talk a little bit more about that.
So what I do is I do the math. I don't just, well, first of all, I want to know the person. I want to know their risk tolerance, their age, their options, the numbers, their monthly expenses. I would never just sit down with somebody and just tell them what to do without having any of that data. That is irresponsible. We are fiduciaries. We have to act in the best interest of every person that sits across from us. So I go through the whole numbers of, do you have living parents? Are you going to be a caregiver and potentially have to quit your job and take care of them? Or do you have other family members that help? Well, do you have children? Are your children in and out of rehab? Are your children living in your basement? I mean, what is your world like? Are you married? Are you single? What assets do you have? What expenses do you have? Are you debt-free? All of that factors into this. You have to go through a half hour of just getting to know somebody before you can even start to figure this thing out, which is why people come and sit down with us, because if you're just in your own head, it's hard for you possibly to get your head around all of this.
That's right.
That's why we offer free consultations. And you can call our office at 478-922-8100, and we answer the phone, live person, put you on the calendar, and we will sit down and talk to you about your options and what we believe is in your best interest.
And, on top of just the number, Sherry, there's the emotion that goes into it. There's the fear factor.
Yes.
I mean, it makes this a very confusing,
Lifestyle.
very stressful event for them.
Lifestyle. Are you going to go on a bunch of cruises?
Mm-hmm.
Are you going to expect to spend a bunch of money? Steve and I, this was years ago, we for some reason both met with a couple, and they were spenders. And we told the guy he had the pension or the lump sum option.
Yeah.
They were burning through money as fast as they could get it. And they were in their 60s. They never learned from anything. And they had never changed their behavior, even though they were going into retirement. We told them, you have to take the pension. You have to have someone else in control of this money, or you're going to blow it all, and it's going to be gone, and you're going to be broke.
Yes, and that my buddy, that's his problem. It's every time he refinances, he fills that void with other stuff and other bills, and I could not imagine him getting his hands on a lump sum and then trying to manage that himself.
Right.
He hates it to start with, and that's what I told him. I said, you say you don't understand it and hate the thought of any of this, but why are you even considering this?
Because of the Schmitta.
But because I guess maybe Schlitz Malt Liquor Bull may have been talking.
Anywho, so then once I get through all of that, of knowing who you are and what you are about and what your life is like, and all of the potential crises, disasters, I don't know what you want to call it, but things that can go wrong. What could go wrong? You have a 95-year-old mother, and she lives here, and you're the only child. What could go wrong? She could need your care. Can she afford care? All of that.
Or one of your children gets into a crack, and they need your help.
Yes. So anyway, and then are you married? Are you single? All of this stuff factors into it. So the first thing if I look at a pension, is I do an interest rate comparison. So let's say you have $600,000 saved up in your retirement fund that could either be taken out and rolled into an IRA and invested, or you could annuitize it. So if you're going to make $36,000 a year in the pension off a $600,000 lump sum, that's the equivalent of a 6% guaranteed payout for life, which is pretty good. Now, the other problem, though, is it's not going to increase with inflation. It's going to stay static. And so you have to realize over time that money is going to become worth less. And so how are you going to deal with inflation on a fixed income for the rest of your life? And so when you retire, and your age and longevity factor all rolls into this.
That's right.
And if you want a wake-up call, visit I'm losing my voice again.
There's something about this building that just hates you.
Visit Living to 100, living2to100.com. Just for fun today. It's going to be a rainy afternoon. You have nothing else to do other than cleaning out your closets. So go to living2100.com and answer the questions and let it calculate for you how long you're going to live. If you're thinking about retiring at 60 and you're going to live to 100, that's 40 years.
Yep.
What are you going to do? And if you lock into a pension payment that is a 6% payout of a lump sum with no inflation increase for 40 years,
yep.
How is that going to work out?
You're going to be going backwards.
You'll be broke.
Yep.
And you'll be terribly broke. And most of them that I see really calculate out to a 3% payout, which is only $18,000 a year. Now, your Social Security, you probably will get that if you don't have a pension that offsets that. But in the Social Security check does actually go up with inflation every year, but it's not enough to live on. You can't count on that. Was never meant for people to live on.
Right.
It was meant as a supplement.
That's right.
So you're not supposed to be dependent upon that for everything. And then you still have your Medicare coming out of that. And depending on how your income, your Medicare could be really high. So there's a lot of stuff to figure out. So can the market do better than 3% over your lifetime? I think so. It has in the past. So the first thing is interest rate comparison. The second thing is inflation risk. So you're talking about a pension at 3%, inflation at 4.5%. You're losing money every year. And I already talked about that. But anyways, that's the kind of stuff that we do and that we look at and we think about. And sometimes I have to really, really go around in circles for a little while to try to figure out what is the best advice for a person, because sometimes it's pretty complicated.
It is, but there's a couple of other things I'd like to throw in here. You have to ask yourself when cash makes sense, okay? Are you worried about your employer's financial state?
That's a whole other thing.
That's another thing you have to consider.
Well, then you have the deal with the pension guarantee fund, which only guarantees. Is that in this article?
No. But you also you have to know that if you're comfortable with investing. If you're not, you're going to have to pay somebody else to take care of this for you. And maybe you don't need the money, so maybe the cash is good. But what are some reasons that it makes sense to keep the pension? You're married. You might want to check and make sure they have spousal benefits in case you do die, survivor benefits. And are you a spender? Like we were talking about my buddy. If you get all that money in your hand at one time, are you going to blow it? Are you going to have any money left? Because I had written this down somewhere, Sharon. Oh, here it is. Let's see. This came out of, I don't see it actually. But anyway, the people who take their lump sum have usually spent that in 5.5 years. And that
oh, no.
Yeah. It's in this somewhere. I just can't see it right now. But anyway, overall, this decision can cause tremendous amounts of anxiety. And I looked up the AARP calculators or information on how to choose between a pension and a lump sum payout. And they have this calculator that they recommended. I have not looked at it. And if you go to it and they want you to pay for it, find another one, okay? But the calculator is at dinkytown.net, and I did not make that up.
Are you talking about rate of return?
No, I'm talking about try the pension calculator versus the lump sum payout. That's what it is.
Okay.
So, but anyway, dinkytown.net, dinkytown.net.
All you have to do is take the monthly payout times 12 and divide that by the pension lump sum, and it gives you the rate of return.
This probably has boxes where you just put in numbers and it tells you everything. So,
okay, so I found it. Pension Benefit Guarantee Corporation. So I've had a number of people take their money out in a lump sum because they were concerned that the firm they were retiring from was going to fail. Mm-hmm. And if it fails, the most you could receive with no survivor benefit would be $3,800 a month, which is more than a lot of people receiving a pension. And it does depend on how much you were going to make, but if your company goes bankrupt, that's the backstop. So that's another factor that you have to think about is what's the health of your company. I mean, look at the postal office. They're asking for another bailout.
Right.
We keep bailing them out, and they have a pension that's guaranteed for life, just like it's a civil service pension. I don't know how long how long are we going to bail the post office out when they have nothing to deliver other than Amazon packages? Anyways, that's a side note.
Yes. But anyway, choosing between a pension and a lump sum payout is not as simple as selecting the box. Well, it could be very simple. You just select the box, give me the money. But that's really
it takes a lot of
very
thought.
Short-sighted way to go about this whole process.
Yes.
And if you're married, please don't make this this decision in a vacuum.
Oh my gosh. I had this couple, they came to see me years ago, and she had never worked. She raised the kids, and she's been a homemaker her whole life. He's worked, was earning a pension. He was on the base. Mm-hmm. And so all the kids are grown, all the parents are still living. They have that as an outlier effect, but she's not working, and so she can be a caregiver without costing them any money. And he had the option of the pension or the lump sum. And he said, and you have other options within the pension. It can be your life only, your life and your spouse. Depending on the pension, it could be his spouse gets 100% if you die, or 50% if you die, and all those options. Or you could be guaranteed 10 years, 15 years. I mean, you got to look at all this stuff. And so he says, he came in and he said, I want to take 100% on my life, period. That's what I want to take, and I just wanted to run that by you. And I said, well, if you die the day after you retire and she doesn't get any money, how's she supposed to survive? and then you got a house, you got expenses, you got food. He's like, I figured. He said, she can figure that out. She can figure that out.
Yeah, thank goodness she was not in the room.
She was in the room. They came to see me together. That's why I was screaming about this. So I look at her, and I said, what do you think about that? And she goes, I let him make all the financial decisions. And I spent the next hour trying to talk him into at least a 50% survivor benefit because he's probably going to die before her. Odds are he's a guy. Women live 5 years longer. He dies. She has no income but a Social Security check. I mean, this is a disaster, and I couldn't convince him. Yep. I could not convince him. I don't even know why they came to see me. What was the point? When
I was working at Fort Gillem, there was a gentleman there that I worked with who was working in the GS side of the DOD, and he was going to retire. And I said, so what are you going to do? You know, it's like, he goes, I'm not going to do much because the life expectancy of males in my family is like this, and he's only like 8 years from that point. And he goes, so I'm going to take my entire pension in a cash lump sum deal, and I'm just going to have fun. I said, well, you know, I said, you know,
what could go wrong?
What about your spouse? You know, what man, I'm not worried about that. You know, she's working, she'll have her own money. And I said, well, what if you live longer? Because the numbers are not in my favor. Well, guess what? He's still alive.
Oh.
Yeah. So
have you talked to him lately?
Yes, I have, as a matter of fact. And he's not financially well off now. So
is this the person we're meeting with next week?
No, not at all. Nope.
Just curious. Nope. I didn't know if that was about that.
No, that gentleman is much smarter.
Okay. And it's not about being smarter or whatever, but it's
about being well thought.
Yeah, you've got to really take this seriously and leaving your spouse high and dry, which is why some of the things that we did, Randy was on the list to go to Afghanistan when he was in JSTARS on the base. And so I came home, I bought $1 million life insurance, term life on him through selectquote.com, dirt cheap, just to bridge us in case he came back with his legs blown off. I mean, that's the reality. This could happen. And I also bought long-term care insurance at the same time.
Mm-hmm.
I wanted to be totally prepared for the worst-case scenario. I'm a worst-case scenario planner. So that's the advice I'm going to give you if you come and see me, because you don't know what could happen. And that's you got to really think through the whole scenario of everything. I could die today on I-75.
Yeah, and you know, there are such great advancements.
By the way, my life insurance is still in force.
Oh, is it good? It's in your life book, I know that. But you know, there are such great advancements going on in healthcare and longevity that having a terminal attitude about when you're actually going to die is not. It's not. You don't hold. It's not the same thing. Not the same mentality. Not the same way of thinking that you had 10 years ago. I mean, things are moving so fast to the positive for us now. You know, some of you may not want to live that long. You know, but because you just are tired now. I don't know. But the odds are in favor that you are going to live much longer than your parents did.
Yep. So, tax rates.
Yeah,
this is my biggest number one call I have had this week. I've had 10 calls about taxes. So, I had a caller from Channel 13. He sees me on the channel, and he says, hey, I'm thinking about cashing out my 401k. I just want to cash it out. I'm just sick of it. I don't understand this. I said, you realize that when you cash that out...
Wait, he was just sick of his 401k?
Yeah. I don't understand this at all.
I don't either.
Anyways, so I said, do you realize that it's 100% taxable as ordinary income? He didn't understand that at all. He was just going to do it and had no idea that it was taxable. And so I said, do you need the money? No. I don't understand the whole conversation. None of it made any sense to me. But anyways.
Did he have heirs that he could leave money to?
We didn't get that far.
Okay.
I said, here's the deal. So when you cash out a 401k, it is taxed at the ordinary income rate. So if you're married filing joint, the first 20 grand basically is taxed at 10%. The next 20 to 80 grand is taxed at 12. And then you get to 81 to 172 grand, it's taxed at 22%. And I said, would you really want to pay all those taxes now? I mean, that doesn't make any sense to me. Why would you want to do that? And he said, I don't think that makes any sense either. And he was gone. I had another one. So I had a client whose husband passed away that I've been working with, and she has a multitude of accounts, and there's a joint account that she had with individual stock positions. She had a joint account with her husband. So how that is taxed is upon his death, it gets a 50% step up in cost basis. So if she sells it, she'll only pay tax on half of the gains. So that you have to go back and look at cost basis and 50% and what the current valuation is and figure all that out to figure out how much she's going to owe in long term. She's had the stock a long time, so it's long-term capital gains. The interesting thing, though, is if you're married filing joint up to $80,000 of long-term capital gains are taxed at zero. She is now single, so she only gets up to $40,000 as zero capital gains. So if she wants to take money out of this account, we're going to have to be careful and keep her under that threshold so that she doesn't go into the tax rate that would charge her 15%, which is the next bracket. So anyways, and then the Roth, she also has a Roth, which she could take money out of that and pay no taxes. She also has an IRA. She could take money out of that, but that's taxed as ordinary income, just like a 401k. So SEPs and simples also tax it. It's ordinary income. So you have to look at the income that you have in retirement. If you have a pension, and then if you do, typically part of your Social Security is going to be taxed. And if you continue working, your tax rate is even higher. So taking money out in that scenario is the worst. So you have to look at the taxes of all of this stuff and make sure you make good choices in where you take money out if you want to take money out. In fact, Steve and I met with a client yesterday, and he wants $50,000 to do housing upgrades on his house. And so I told him he's married filing joint, long-term capital gains. He's had the positions in his portfolio over a year. I said, you'll be taxed at the long-term capital gains rate because you're married filing joint. That's up to $80,000 at zero. So you can take the money out of that account and pay zero tax. And so it's just a big thing to understand. Let me see what else. So Biden wants to increase the top marginal capital gains tax rate. Biden's proposal to tax capital gains at higher ordinary income tax rates would lead the U.S. to have the highest top marginal tax rate on capital gains in the developed countries. The proposal would tax long-term capital gains as ordinary income for taxpayers with taxable income above $1 million and raise the top marginal rate to 39.6%. This came up this week for another reason, that if you're selling something and you're going to make money on it, and you do it this year, you're only taxed at
long-term capital gains.
Yes.
And if you take the lump sum next year,
it could be 40%.
It could be 40%. And actually, the way it's looking, it's going to be 48.4%. Because in addition to the 39.6% tax rate, you have to combine that with the net investment income tax, NIIT, and the average top state capital gains tax on top of that. So it's going to be very, very expensive in the coming years to sell a business. So you really have to get with the tax accountant and figure out the best way to maximize your return, because you may have spent 40 years building a business, and then the government's going to the government's going to have its hand out for half of that when you decide to sell it. So you've got to figure out great strategies to help yourself get through this without losing money yourself.
This would be a really good seminar to do for business owners, and we could probably do it in combination with the SBDC for vet, because they do valuations for free. I got to make a note of this. This would be really, really excellent. And how to plan in advance. I met with a client yesterday that has a business that he will likely sell in 10 years, and it'll be interesting to see how that goes. And I've had a lot of people have businesses where they've brought somebody else on already, and they're training them, like Steve brought me in, and then I can become Steve. They do this over years and years and years, but they're not selling. They're not in the selling process yet. So understanding the sale of a business is huge. And some people, I've had clients that thought their businesses weren't worth anything because the traffic was not what it used to be. But you have materials and machinery and space, and I mean, it's worth something. So The SBDC is next door to our office in Macon, right across from River Crossing Mall, and you can make an appointment and go see them. They are open for business now, finally. They're in the office, and you can talk to them about your business, and they can pull up statistics on businesses that are like yours, and they can tell you what the average business of your type goes for and help you lay out a plan of how to do this, how to finance the sale, all of that stuff. That is what they specialize in.
Well, I was having the conversation with my physical therapist the other day about this. He was asking about the sale of his business, saying he doesn't know what he's going to do because he doesn't see the value in it himself after he's gone, because he has no succession plan. Nobody is in the pipeline to take over his business. So it's much easier to sell your business when you have cultivated that.
So is he just a single practitioner, or does he own a whole business and has a bunch of people like him doing this work?
He is the owner. Him and his wife are. And,
oh, wow.
And they have
that's a big deal.
And they have a bunch of peeps in there helping people. So it's a very good operation that he's got.
I don't know why I figured that was a chain. I don't know why I thought that.
Yeah,
I didn't know it was a standalone thing.
But I got to tell him. I said, I'm sure as a physical therapist you're part of an association. And I said, you need to get with your associations and figure out what they can do to help you. One, find a buyer for the pipeline. Get them in the pipeline.
Get them in there now.
Go ahead and write the succession plan. That doesn't mean that's the price you're going to pay today. It means that it's an agreement between you and one other person or a company to buy your business when you decide to retire at an undetermined point down the road. There's so many ways to you have so many resources like the SBDC, but these associations, they usually have models that you can program your specific business into.
So Randy's become an expert on this in the last 2 months because he's been doing the valuation for Steve and working on all the numbers and the calculators and what are the averages and this and that and what is it worth. And it's been a lot of work.
It's been a lot.
We went through tax returns. I mean, it's been a pile of work.
What we came away with is that we need to start looking at it the business evaluation for us going forward in a different light, other than let's just do business and sometime down the road we'll decide to retire and we'll do this whole thing one more time. Businesses, I believe, should be looking at it on a continual basis.
I agree with you.
When you get your...
What is it worth today? How has it grown? What's the history? What's the track record?
Like in our line of business, age means a lot, in the valuation. So...
and do you have a successor working with you?
Yep.
Do you have a potential successor that could take it over, which is a big deal?
That's right.
And if you don't, finding that person now rather than later is a good idea.
So there's a lot of factors. What we're saying is there's a lot of factors that go into valuing your specific industry. Some may, like the physical therapy, they constantly have a new stream of customers, and it doesn't matter. It can be 20-year-olds to 90-year-olds, which is what I see in there. And whereas our business, the younger the client, the more the business is worth.
So how did you look into having the owner operating on you in there?
I don't know.
Because he's doing a really, really good job. It's the best therapy you've ever had in your life. I'm shocked at it.
In a matter of 2 weeks, I'm able to use my right hand again, so it's good.
Wow. But anyway, so yeah, if you're a business owner, you need to really sit down this weekend and make a list of what you need to do to prepare for the future. And you might need to go, just think about and really consider your family situation. And if you're a sole proprietor and you don't have a succession plan, I would think that you need to buy a big pile of life insurance to bridge your spouse if something were to happen to you and you couldn't operate your business anymore, so that they have a bridge or enough savings or something to hold them over until they can sell it. But they need to be involved too, because they need to understand how's this going to go, how's it going to affect them. And then usually the buyout is not a cash deal. It's usually over a period of time.
That's right.
Of years.
Mm-hmm.
So that whole thing is worth your consideration.
Shirr, I want to go back and I want to talk about corporate taxes, okay?
Mm-hmm.
Investment income from corporations is going to be subject to corporate tax in addition to capital gains taxes. A business must first pay corporate income tax, and therefore investors see their gains from after-tax profits. The integrated tax rate on corporate income reflects both the corporate income tax and the dividends or capital gains. The total tax levied on corporate income, which is the the total tax levied on corporate income. The integrated tax rate on corporate income distributed as dividends would rise from 47.3 currently to 65.1 under Biden's new plan, which is the highest in the developed countries. So we are under a different.
It's called you got to pay for all the free money.
That's right.
You got to pay for all the free money somehow, and they're still
I'm speechless, really.
I know. It's depressing. All right, let's move on.
Yep.
So the good news is this tax hike is bogged down in Congress.
Yay!
Wealthy Americans wondering how much taxes they'll owe after Democrats pass their sweeping social spending package may have to wait until deep into the fall or later to find out. And you know what I think this is about? I think all these yahoos up in Congress are trying to figure out how to pass a law that doesn't affect them. They want to hurt everyone else and make these supposed rich people pay their share, and they're going to get away with not having to do any of it.
I don't doubt that.
Anywho.
But what they're doing is they're buying votes because they're giving free money to everybody for any reason they can possibly come up with. So I mean, but people need to understand this is your money. So if you're not writing your congressman and saying enough's enough, then you're setting yourself up for higher taxes.
I'm not going to talk any more about that. It makes my head hurt.
My gizzard hurt.
All right, so this
something
is
positive.
So I talked about this on Channel 13, and they aired it Tuesday night, and I had a phone call this week, and I neglected to talk about it on the radio show. So I'm glad that this lady called, and she said, you talked about something about medical billing Tuesday night. Can you tell me more about that? And I've got the article if you want, and I can send it to you. So on July 16th of 2020, Governor Kemp signed into law a bill called Surprise Billing Consumer Protection Act. It took effect January 1 of 2021, and the new law aims to stop surprise billing to patients who have received out-of-network care from healthcare providers and facilities. These unexpectedly high medical bills are often called surprise or balance bills and often result from specialty procedures like emergency room or trauma surgery and anesthesiology performed by out-of-network specialists, which is what happened to this lady.
Yep.
She went into the hospital for a procedure. She had no idea that the anesthesiologist, was out of her network, and now she's got an $800 bill that her health insurance expects her to pay because that's who did the work on her.
You know, even in the VA, when you go to an out-of-VA hospital, like say over here to Atrium, and I've been there a few times, and they will give you a breakdown of what the costs were, and there's just page after page of
ahead of time or after you already have the stuff.
After you get back and they say, here's how much the VA paid on your behalf, and here's what each of those line items were, and it's amazing the different people they bring in to do various things that you never once.
It's a village.
Yeah, right. You never once get the ability to say no. I don't.
Well, you're in a coma. They put you under.
That's true.
They put you under an anesthesia and they roll you into a room and a whole bunch of people are doing stuff to you, and then you roll you out and you wake up later and you have no idea who did what.
They duct tape a pin to your hand. Here, sign here.
So when balance billing is prohibited, here you go. Under the new law, balance billing is prohibited in the following circumstances. 1, emergency care. Whenever any out-of-network provider or out-of-network facility furnishes emergency medical services to an insured patient, regardless of whether the patient has advance notice or a provider's or facility's out-of-network status. And 2, non-emergency care. Whenever any out-of-network provider furnishes non-emergency medical services to an insured patient at an in-network facility, which was this lady's experience, if that patient was not first consented to receive that care from out-of-network providers at the in-network facility, they do not pay the bill. They're not liable for that. And she's been billed 4 times this has happened to her. So I sent this to her and I said, you need to send this to the people that are billing you and have them wake up that Georgia has this law. Good morning. You're on with Randy and Sherry. We just got a few minutes, right? Good morning.
Hello.
Hey, we're here.
Okay. You keep talking about all these things that I've heard of, like step-ups and all manner of ways to take your taxes and pay 40% now and 20% later and different things like that. Who do I go see that can sort all this mess out? Because number one, I'm not going to be here very much longer.
Well,
you don't know about that.
Yeah, I do.
I hate to hear that. Well, if you're talking about a step up in cost basis on say, some
I'm just talking about the whole ball of wax with dealing with taxes and loss of a spouse and all this kind of business.
Well, you can talk to me. We have offices in Macon and Warner Robins, and you just call 922-8100, and you make an appointment, and it's free. And you bring all your stuff you're worried about, and we talk about all of it. And the positive news for your spouse, if you did pass first, everything gets stepped up to the date of death value, except for retirement accounts.
Yeah.
Your house, she could turn around if she decides she didn't want to live there anymore. She could turn around and sell it and pay no capital gains tax. So we can talk through all of that.
Okay.
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 Right.
Good.
We have openings on the calendar. If you just give us a call, we'll be happy to meet with you.
Yeah, I'd like to meet you anyways. You've called in so much, I'd like to know who you are.
Actually, we met at the doctor's office one day.
Oh, really?
Yes.
Well, I don't know when that was, but
It's been a while.
okay. Well, yeah, just give us a call and get on the calendar and just bring all your stuff you're worried about, and we'll figure it out.
Okay. You say bring all my stuff. What?
Your investments, we're going to send you a 2-page sheet to fill out, and on that sheet you're going to put down the value of your investment accounts and what type of accounts they are, and we'll talk through your property and all the stuff that could be what would be affected by a step up in cost basis, and if you have who everything passes to and how that's going to flow and all of that.
Okay.
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 Good.
Did you get that number?
Yes, sir.
Okay.
Yay.
Great.
Give us a call next week.
Okay.
All righty. Look forward to seeing you.
You're welcome.
But anyway, so if you've received this astronomical bill because somebody who did something to you was not in your network, you need to stand up for yourself and fight it, because that's why Governor Kemp passed this law. Now, when balance billing is not prohibited, the new law does not prohibit balance billing when an insured patient receives non-emergency medical services at an out-of-network facility. So you choose to go to some place because you really like it and you've heard they're great, but they're not in your network, you can get billed. You choose it, you're going to get hammered.
Or you have the sniffles and you go to the emergency room. If you have something that's not life-threatening and you go to the emergency room.
And it's not an emergency.
You are going to get raked over the coals financially.
It's expensive. Go to a med stop. Anyways, so I can send this to you if anybody wants to read about this, if you have this problem.
I think that was a great thing Governor Kemp did.
It is.
It's really good.
And then it goes into what facilities are not covered, and providers are covered by the new law. Anyways, I'm not going to talk about that anymore. How many minutes do we have left? 5?
How many?
What? 2. God,
Sherry, I think we should talk about.
Oh man, we got a really good article.
We want to talk about a big ass salad.
You can't say that on the air.
I can too.
It's the title of the article.
It's the title of the article.
The secret of big salads. But anyways, this talks about modern science and how scientists have discovered hundreds of phytochemicals and micronutrients that are found in plants. And in short, that we need more of these in our bodies. We need less donuts and processed garbage and more vegetables, fruits, beans, and seeds. And I'll give you a couple of examples, and I can send you this article. It comes out of a financial newsletter that we subscribe to. It talks about raw green vegetables associated with a healthier pancreas, colon, less breast cancer. It talks about mushrooms, cabbage, cruciferous vegetables, pomegranates, berries, and what each of those things does. So here's what they recommend. Every day they want you to have at least 1 large salad, at least half a cup of beans, at least 3 fresh fruits, at least 1 ounce of raw nuts and seeds, and at least 1 large serving of green vegetables, raw or steamed. And to cut out all the processed garbage that's just full of junk, clogging up your arteries. So if you're interested, let me know. I'll ship it to you. But the most interesting thing to me was about mushrooms. Frequent consumption of mushrooms can decrease the incidence of breast cancer by as much as 70%. That's crazy. I'm buying some today.
Yeah, and there's many other points in this article, so I do encourage you, if you're looking for a better way of eating, it maybe help you lose some weight or whatever. It's a great article. Email us, Randy at RFMoney or Sherry at RFMoney.com, and we will get this to you, because there's each of these different nutrients that they're talking about have different effects. You can lower the risk of certain kinds of cancer, colon cancer, and etc. So,
let me put something
okay.
else. I was going to talk about this more, but you need to download on your phone. It's absolutely free. MyFitnessPal.com. The app, MyFitnessPal.
Very good.
Track all your food you eat and see how much fiber you're actually getting. Because I get 25 grams a day because I've tracked it and I know what I need to eat, and that is life changing. I mean, you feel so much better. You're full faster, longer. I mean, it's just healthier for everything. So there's lots of things you can do to get healthier that don't take a lot of effort, and you can't replace this with pills and supplements.
That's right.
That's the bottom line, he says.
And Shirr, we're down under 2 minutes, but if anyone out there has a church, an organization, a business,
reach out to us. We can come do a talk for your people.
These talks are absolutely no cost to you. Okay, so do not hesitate. Call us at 478-922-8100
or email me at Sherry SHERRI at rfmoney.com. You can always go to retirerelax.com if you don't remember any of this or you're driving, and you can get our contact information there and just email us or call us and have us come out, and I could do a life book presentation, and I could do the presentation I'm doing at Watercrest on longevity risk. I mean, that's going to be a lot of fun.
But we are Rosenberg Financial Group. We are located in Macon and Warner Robins, and we are fee-based financial planners, but we have a very wide spectrum of what we can do for you. So,
including complimentary consultations.
That's right.
Yay.
Have a good weekend, everybody.
Have a good weekend.
The views expressed on the show should not be construed directly or indirectly as an offer to buy or sell any securities or services mentioned herein. Investing is subject to risk, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should only be relied upon when coordinated with individual professional advice. Securities are offered through Royal Alliance Associates Incorporated, member FINRA and SIPC. Advisory services are offered through Rosenberg Financial Group, a registered investor advisor not affiliated with Royal Alliance Associates Incorporated. Offices are located at 2517 Moody Road, Warner Robins, and 4875 Riverside Drive, Suite 201 in Macon. Phone numbers are 922-8100 and 741-4457.